part of Financial Planning Association, pro bono group. I also run my own financial planning and wealth management practice in Campbell. I'm happy to present and give you some ideas. For full disclosure, I'm not a tax preparer. I'm a financial planner, so the overview of the tax law will be very general nature, but I'll try to give you as much information as possible to make certain decisions or make them easier, or maybe we'll bring up some ideas that you might want to take it back to your tax preparer. So let's talk about what changed, what has passed, and what we see might be changing going forward. So there is 2 laws that has passed at the end of 2021. One was an Infrastructure Investment and Job Act that was signed into law in November last year. And this is known as a bipartisan infrastructure framework that addresses a lot of traditional infrastructure provisions related to buildings, road, bridges, and broadband. So basically, it helps the economy to a great degree, because every time government increases spending, we have more jobs, lower unemployment, and in general, more stable economy. So that was a good thing for the economy, good thing for employment, and we're still learning about this act. There was nothing about taxes related to this new act. So the next one, though, which is Build Back Better Act, as well known as BBB, or the Reconciliation Bill, that's the one that causes the most frustration for all the tax preparers and planners, because it's very convoluted. And also, it had numerous revisions after it passed. So it covers 2 topics: the legislation containing social, environmental, educational infrastructure changes and provisions, but also touches on some tax laws. And it's been a lot going on back and forth on what provisions will go into effect, how they will affect the individual tax brackets and corporate rates, but also talking about which provisions potentially might not be passing. In general, what I would like to say that it's much better bill than we expected. In what sense? We expected much higher tax increases, especially on the capital gain side. There were some proposals to stop giving cost basis step up after death on inheritance. So all of it has been dropped. It's not part of the provision. However, the caveat that there still will be some changes, most likely going into effect March, if possible this year, that will affect retroactively 2021 filing. So please be tuned in to see what potentially government will pass as a final bill in March. That will affect all of us and all our filing statuses for 2021. So that's what I'm warning everybody here. But today we'll talk about what we know based on the most recent revision of the act.
Larysa,
Yes.
Somebody asked if the Build Back Better bill has been passed yet.
It has been passed, yes. So if you look here, it has been passed, but there is a numerous provisions that been still continuously changing. So there's been 3 revisions of it at least. The last one, as I know, was in November. So in general terms, yes, but there is a lot of provisions that still will need to be acted on and need to be signed into law. Believe it or not, how strange it does sound, because the bill is so big, it's over 1,000 pages long. There are certain provisions that still doesn't have agreement between the Senate and in Congress. So I will give you an overview what it looks like. However, please keep in mind, a lot of it can change before April still. So, but this is what we know. We know that in the last revision of it, did not increase corporate taxes, which is great. It also made certain positive impact on Californians, which we'll discuss. And it also changed certain brackets. In general, this tax law is not very dramatic, how it's going to affect most taxpayers who makes between, let's say, $100,000 to $400,000. Those who make over $400,000 probably will see certain taxes increase. We call them surtaxes. There will be additional tax to pay on certain taxpayers over 400 plus taxable income, $400,000 plus. So please take a look at revised tax brackets. This went slightly up. We're still keeping the same tax brackets rates. However, the amounts of the bracket from single head of household merit slightly shifted. They haven't increased that much. They just shifted in a way that we used to have 600. I'm looking at the old brackets. We used to have the highest number over 647 for 2022. For comparison purposes, it was for merit filing jointly 628,000. So because of inflation, these numbers went up. I'm not seeing a big change in the revised brackets. So it's pretty much will be about the same. Individual long-term capital gain rates for stocks and qualified dividends. It's been a huge discussion about raising capital gain tax rate for anybody who makes more than $400,000 in capital gains each year. Even more tax increase if you're making over $1 million in capital gains in a year. However, for right now, that hasn't been enacted and it stays the way it is from 2021. So no changes here. So if you are merit filing jointly and your income is only $83,000, including capital gains, that you expect to pay zero capital gain tax. So a lot of times what we discuss with my clients is, if we want to sell particular appreciated security, how do we sell it in increments so we pay little tax or no tax on it? So be very aware of that. When you realizing capital gains, it adds on the top of your adjusted gross income, and that sum is considered for your overall capital gain tax. And then let's say it's over $80,000, but only $2,000, entire amount of gains will be now taxed at 15%. That's why it's very important to watch your gains, also watch your income to see what would be the most advantageous for you when you sell some of your appreciated stocks or mutual funds. The big four questions clients ask: are my tax rates going up? Are my capital gains going up, which we just looked at? What happens to my retirement planning? And must I redo my entire estate planning? So today we will address a few of those based on the latest revision we know exist from the BBB Act. So are your tax rate going up? Looks like not. They're not going up as we looked at the tax bracket at the moment. They're staying pretty pretty much on the same level. They're not changing a lot. However, taxes may increase because of changes that's related to something called NII. And NII is a term for net income, investment income. So if your net investment income of over a certain dollar amount, and there is some numbers, if your taxable income is greater than $400,000, for merit is 500, then you will have to pay NII on that amount, which is 3.8%. We call it also Medicare surtax. There are some tax changes that will be affecting uber wealthy people, and it's anybody who's adjusted gross income over $10 million. I'm not going to stop focus on it too much. If you have any questions, you can let me know.
Oh, there is a question, Larysa.
Yep.
Somebody
Sure.
asked if the capital tax is based on the adjusted gross income or just on the profit of sold stocks.
Great question. So the way it's calculated, and I can go back and just give you an example. So let's go back to this capital gain tax chart, right? So if your total adjusted gross income exceeds $80,000 for merit filing jointly, that number already will include your capital gains. Then you will have to pay 15% tax on the gains themselves. I'll give you an example. Let's say you are a retired person and the only source of income is Social Security. You're drawing $40,000 in Social Security or pension benefits. And in 2022, you decide to raise capital and sell some stocks, and you realize another $30,000 worth of gains. Now your adjusted gross income before deductions will be 40,000 plus 30,000 gains. It's $70,000. And let's assume you're married. So now you're falling under the category of married filing jointly with AGI below 80,000. So what will happen is you will pay ordinary income tax on your pension benefits or Social Security. That's at $40,000, but you would pay zero tax on your capital gains because your total adjusted gross income falls just below that number. If in opposite, you sell more than 40,000 worth of stocks and your adjusted gross income went above 80,800, then you will be immediately paying 15% on that capital gains total. Okay. So the good news is all of these brackets have not changed much. And we're seeing that the highest rate at the moment is 20% for capital gains, regardless pretty much of the amount. However, remember the previous slide, if you make over $500,000 in gains alone, then you will be subject to 3.8% NII tax. So that's still there, and it's been there for a while. All right, so let's talk about, I apologize, I'm moving too fast. So I just want to, all right. So let's talk about a couple other things. This is probably one of the most exciting news about the SALT taxes. If you remember, a lot of Californians had to only cap their property tax and state tax deduction to $10,000 in the last couple of years. And it's been very painful because in general, Californians, because of the higher property values, pay a lot of property tax. Only those who stayed in their homes for 30, 40 years probably pay less than $10,000 in property tax. Majority of people pay $20,000 plus. So the 2019 Act limited how much we can deduct. We call them SALT deductions, state and local taxes. So between property tax and estate tax, our deduction was limited to $10,000. Now they raised this number to close to 80,000, which is a huge advantage to those who file and do itemized deduction. Why? Because now if your property tax is 20,000 and your state tax is another 30, you might be able to deduct entire $50,000 as an itemized. So this is a great news to those who are paying higher tax on state level and also higher property tax. It will be a great tax savings going in 2022. Not to get too excited about that, it's going to be sunsetting in 2031 and going back to the old levels, but yet to be seen. There is a lot of time between now and then. All right, so let's look at a next slide to see, you know, what else we need to consider. And one of the biggest, I think, one of the biggest advantages of, you know, of current situation is we'll talk about estate taxes. That estate taxes will stay at the same level, and I will make you familiar what those levels are. So other tax proposals. Before we go to corporate taxes, I want to touch on this. So people asking if you need to redo your estate plan. In mid-2021, my answer would be it depends, because the Biden administration was proposing reduction of estate exclusion close to $5 million. And if you're married and you have an estate over $10 million, potentially you could have owned estate taxes if both of you passed away. Now they decided at this point to keep a highest ever we've seen exclusion, which is $12 million per person. So nobody will be subject to estate tax if your total estate is over $24 million. So they still stay in place, which means you don't need to address your, let's say, estate tax situation, but you need to be aware of that this higher exclusion amount only stays in place till January 1st, 2025. If legislative changes are not going to be happening in the next 3 years, and there will be no law changes, this higher exclusion amount will sunset and go back to $6.2 million per person or $12 million per family. So the exclusion amount will be cut by half. If they will enact a new law on the state side and reduce these amounts accordingly sooner, it's potentially can be triggering necessity for you to talk to your estate planner, your financial planner, to figure out what's your strategy to minimize estate tax. Estate taxes are very difficult to avoid unless you do a lot of planning ahead of time. Other tax proposals, special 75 and 100% exclusion rate for gains for certain qualified small businesses. Unless you are a company that qualifies under this paragraph 1202, it doesn't have any interest to you, because it's mostly talking about companies who fall under this category. And if they sell the business, they don't have to pay capital gain tax on majority of the proceeds. This is an amazing benefit that I'm surprised is still there. I had a client who invested in a private company that was subject to these rules, and they recently sold majority of their investments, realizing thousands of dollars in gains, and 80% of it was excluded from taxation. So it's the way that government stimulates the business activities, and it's extremely advantageous on the tax side for people. Any questions so far before I move on to the next slide? I'm not seeing, there are some, but maybe I'll address it later on. Revisions on the corporate side. So something for us to be reminded that corporate tax rate affects how much corporations are keeping in their balance sheet end of the day, meaning how much money available for them to research and development, for hiring, for expanding businesses. So when the rates are high, like in Europe, it's very difficult to do business. It's not very profitable. So the business activity subsides. In the United States, currently, we have one of the best tax rates. They're very low. The corporate tax rates range between 20 and 24%. And the biggest idea on the Biden administration, when they were working on the proposal to raise the, Biden was asking to raise the rates to 28%. So right now, this revision was dropped and the rates stay in the way they are. They haven't changed, which helps corporations, obviously. And as you know, if corporations showing more profits, it translates into the earnings, and that also translates in supportive environment for the stocks, because the more companies showing net earnings and it's reporting on a quarterly basis, the public companies, then the better potential appreciation of the stock will be in the future. So in one sense, it's good for the economy, it's good for stock market. Obviously might not be as good for budget. So I think they probably will address this in the future just to make sure that they are getting enough revenue from corporations. I will touch very shortly on NII. There is a lot of other things we can discuss. What I want to focus on the second half of the presentation on the tax strategies that you can potentially review and look into, just besides the updates we're doing. So you have some actionable items to consider. We talked about NII, so it also will apply to business income, not just of individual income. And now let's talk about things to consider and what we can be doing. This slide depicts the tax advantage of 401k and any employment plans. The the green line showing if you invest money on a tax deferred basis, 401k, IRA, anything that's tax deductible in your tax return each year. Remember, when you put money in 401k, you reduce your overall income. Same applies to regular IRAs. So when you grow your money tax deferred and you're not paying taxes till much later on in life, you have a huge advantage of growing your money faster. That's what the green line is showing. It's quite different if you have to pay immediate tax on every earnings and then invest it. So please make sure that you take advantage of your 401ks, maximize them, IRA contribution. If you have any earned income, you could be eligible for either deductible IRA or 401k. 401k contribution amounts are not limited to your income. However, deductibility of IRA accounts goes down as your income goes up. If you're making over $220,000 in total income between husband and wife, then most likely you will not have option to have a deductible IRA. Then you have other options we can talk about. Roth IRA. So let's talk about traditional IRAs versus Roth IRAs. What makes sense? Traditional IRAs are great for those who are trying to maximize deduction today. The Roth IRA is another option you should consider, and it's very valuable account for those who are eligible to make contribution into Roth. And if they are not, I will explain what other things you can do to start creating your Roth account. What's the Roth account advantages? Two biggest one. First is your Roth account is the one that grows tax-free. So if you put 10,000 in a Roth account and by the time you retire, it's 50,000 with all the gains. When you take the money out, there is no taxation, not on a gain, not on the principal. Another huge advantage is there is no required minimum distribution. If you remember, we had a new law passed at the beginning of 2020, but because we had COVID, everybody was so busy, it's kind of went under the radar. But required minimum distributions for any retirement accounts date moved up from 70.5 to 72. So now you're required to take money out of your retirement plans the year after you reach age 72. You have to do it by April 1st. So try to think about what if you're working, you have earned income. You cannot contribute into IRA or Roth if you don't have earned income. But if you do, you can start thinking about Roth account as an addition to your IRA account, even though it doesn't give you deduction. It's a fantastic way to earn tax-free income in the future. When to opt out for Ros Conversions. A lot of people talk about it, and sometimes they do, sometimes they do it not exactly in an optimal way. And I will explain why. IRA to Ros conversion creates an opportunity for you to roll money from IRA into Roth and pay taxes on the converted amount. So if you are between jobs, or if you're just retired, you're not collecting Social Security, your total income that you're reporting in a particular year might be lower. That would be a great opportunity for you to review if your Roth conversion is advantageous. When you roll money from IRA to Roth, you need to see how much taxes you pay on that sum of money. And if your tax bracket on that amount is fairly low compared to your tax bracket once you start collecting Social Security and have RMDs, and it will be taxed at a higher rate, you might be you might be benefiting from saving taxes and converting some amounts now. You need to be very careful not to convert too much, and I'll explain why. Conversion considered an income, and when you're collecting Medicare, your total income is considered for Medicare premiums. So if you earn after conversion amount greater than certain dollars, your Medicare premiums will go up. So you have to be very careful within which bracket you're staying not to increase your Medicare premiums, because if you do, it will take you the whole year to get the low premiums back. IRS, Social Security Administration will reassess your premiums, and that will take you the whole year till you can reduce them once you file the following year tax return. So you have to be careful. Conversions make sense, but you need to be very careful what rate you're converting and what kind of Medicare taxes you potentially will pay if you do convert. It's a great strategy, especially because 2022 doesn't look like will be a year of higher tax rate increases, and it still continues to be very advantageous to look into Ros conversions. If you look at the tax law all the way back to 1960s, you can see that we're still in a very low tax rate environment. Even though it feels like we're paying a lot of tax, if you go back to 1960s, you will see that how much taxes we paid compared to what we're paying now, it's still giving us a lot of advantages to do a lot of tax savings through these strategies, just in case the taxes will go higher. And I think they will, because of the humongous budget deficit we just created because of COVID. We printed 5.5, if not $6 trillion and threw it in the economy to keep it going. And because of that, we need to refuel the budget, and that will, tax increases is one of the easiest way to do it. I don't want to touch on health savings accounts. I don't know how many people are interested, and we also need to make sure we leave enough time for answers. But I would like to talk about mortgage deduction. So it's still a big advantages to those who are still carrying large mortgages. Something to keep in mind that's been changed, that you can only deduct mortgage on the amount $750,000 or less. If the loan was secured or issued in 2018 or after. If the loan was secured prior to that year, then you can still deduct after up to $1 million loan, interest on the loan up to $1 million. I just wanted to share this map with you. A lot of people considering moving and saving on state tax, and especially those who are retiring, searching for better tax brackets once they're in distribution mode. So this depicts and shows you which states has the highest tax rate, and unfortunately California is one of them. I've seen a big trend that started pretty much around the COVID time, where a lot of people no longer need to work in the place in the Bay Area. They can work remotely, and because of that, the decision was made to move away of California, pay less taxes, and still work remotely for a California tech company. And as a result, we start to see that people going, a lot of people going to Oregon, Washington. Obviously, the areas in gray carries no state tax, so they're very advantageous to retirees. So if you're concerned, or if you are a higher taxpayer, those states can present a big opportunity for you. I don't know, Lisa, if we should go to questions or leave them to the end. I see they're popping up.
Up to you.
Up to me. Maybe I will see if we maybe go to a couple more slides, and then I will take questions, and then I can always go back to other tax planning strategies we will discuss, because we don't have too many left. So let me try to address a few questions, and then we will go to the next slide. So let me take a look here. So thank you for getting all of these answers here. Senator Manchin said this week the bill is dead. Yes, I read that as well. So potentially we will see, yet to be seen. You know how it goes with the government. It's a lot of politics and lots of lobbying going on right now. So it is a proposal with several revisions. So what I am showing right now, that's the latest revision of the bill. And if they're successful, they will pass all of this in March. But regardless whether they pass it or not, the bottom line is it's going to be not as aggressive as we thought originally. The capital gain tax will stay pretty low. The tax brackets are not going to change as much. So the biggest target is on ultra wealthy or those who are making over $500,000 worth of income. There will be some surtax applied to them.
I think I got all the other questions up to Mike's question, which is, he asks, is it advisable to convert undervalued stocks in a traditional IRA account to Roth?
It's a great question. So yes, I think it's if you're considering, if your tax bracket is not going to change a lot, and it's going to be lower than your tax brackets in the future, then by converting, you are moving, let's say, suppressed, we call it suppressed value security, right? So undervalued stock, let's say you have an example, could be a company that's still showing a very valuations. You're moving it from your IRA to Roth, and then over the course of next 10 years, the value of the stock goes up exponentially. So all of these gains that will be in a Roth account will be sheltered from taxation. So that's correct. Yes, it's a great way to shelter it. Also, when you're passing on certain, some people like to do gifting to kids. Adult kids for a number of reasons, to support them, sometimes to avoid estate taxes and pass that to children sooner. So when you're passing on a highly appreciated asset from you to the children, you're shifting that gain, taxable gains, to them. And if the account or the stock continues to appreciate, then all of this money will be out of your estate and passing to children's estate. So that's another strategy, not related to taxes, but more related to estate planning. We don't provide tax filing services. We provide tax strategies. So we're looking at the big picture, and then implementation of those strategies. We usually work with CPAs, your CPA or CPA that we're comfortable with to implement that.
And asks if you could touch on how the alternative tax bracket impacts the taxpayer and what can a person do to get out of that bracket?
The bracket. So there is items that subject to AMT tax, and it's not easy to get out of AMT. It's basically a tax where you if you make a certain dollar amount and if you have certain income, they're kind of drawn back into the alternative minimum tax calculations, and it's very difficult to avoid it. The way we seen CPAs and tax preparers do is they try to help clients to minimize those alternative minimum tax items that draw you back into AMT calculations. For instance, people try to earn income as like muni bonds. Muni bonds would be one of the example, and other type of incomes that increases your AMT income. So, but it's unfortunately very difficult to avoid. There's few strategies based on your personal circumstances. Example is, let's say you're getting certain stocks, and you're part of the deferred compensation plan as the executive. So we can work with deferring some of your income in the future years after you're retired to keep your overall tax bracket lower. But in general, it's very difficult to avoid. If it would be easy to avoid, they would not assess AMT on people. So it's hard to avoid, and it's in general, you just need to be aware of what potentially can kick you in that AMT calculations, why your alternative minimum tax is assessed. Once you know why, we can dissect which particular income we can potentially reduce. But if you're gaining a good amount of income through employment or through passive income, sometimes it's impossible, impossible to avoid, right? I mean, you're not going to stop getting W-2 income or rental income because of that. So I hope that helps, but it's not very easy. You just sometimes have to pay. And, I can give you, examples of, AMT items. It could be interest on particular private activity bonds or accelerated depreciation on the properties. exclusion of the gains on the qualified small business stocks. By the way, we talked about that just recently, right? Those particular stocks. So those are all included and they're called AMT preference items. Let's see. Okay, so we don't have any questions yet. I'm going to just move forward with the residency and timing transactions. So when you're considering a large transaction, let's say you're living in the state of California and you know you'll be selling a business later on, and your business is a pass-through company, which means most of that income will be passed to you. You can consider moving to a different state, and even though usually you're taxed at your state taxes are levied on you based on where you earn the income, there are some exclusion can apply based on your residence. So we've seen those states that have a lower or no taxes. So when you're contemplating large transaction, maybe you're selling a business, maybe you're having a big stock options, and you have an ability to move around. You need, for a number of reasons, that you consider different states for that purposes. If the savings are obviously justifiable, and also moving not just for taxes, but for other reasons as well. Talking about the Ros Conversions, remember the Ros Conversions, it's not federally just federal taxes, also state taxes. So when you're making calculations, make sure you include all of those in your estimate before you make a conversion. A lot of people make mistake, they convert large amounts and once they don't want to deal with converting year after year, and in generally it's not a good strategy. You need to convert only small amount to stay under a certain tax bracket. Conservation easement as the tax avoidance strategy. I am not familiar with that. It's not familiar to me. So I can get back to you on this and look at the tax code, but I'm not ready to, I know it's a tax deduction, but I'm not ready to talk about it. I know that landlord who earns, let's say, 50,000 a year can donate $1 million conservation easement, could potentially have some deduction, but I don't know the ins and outs and details of that. So it's a deduction related to landowners, looks like. But if you're interested, we can discuss it offline and I can do a bit more research. What is the guidelines to claim a trader status? It is possible to claim for one who is doing trading actively and also having a permanent job. I believe so. I think you can be a trader. You have to establish a business. Doesn't mean you have to open a corporation, but you need to have, first of all, you need to spend some good amount of time trading, and you need to document it because you become a self-employed, right? So you are in business of making money in the stock market. So you have to segregate any of the activities you're doing as a self-employed from your regular employment, meaning any cost associated, open a separate account. If you want to establish LLC, you can do that, or you can just do as a sole proprietor. You need to have a separate account. You need to have expenses associated with the business. You need to record it. You need to keep your books or QuickBooks or regular Excel sheets. You need to treat it as the business. And only at that point, and there's a couple other requirements that you can check with your CPA, but you can make it as a business. And remember, IRS does not require for you to report gains in the first couple of years of any business. So if you have some losses, you can write them off, but you need to be careful of keeping all the records separately. In case of audit, you need to be able to show all your expenses and income. And speaking of that, something that as a reminder, we need to know that IRS ask for a big budget increase for them in order to be able to audit more extensively and more aggressively. So they hired a lot of people. And in the coming 2022 and 23, they're expecting to increase the audits tremendously. And people who will be subject to audits looks like will be those who are making over $400,000 and self-employed. So business owners and those who make over $400,000, business owners, most likely will get some sort of scrutiny and a bigger scale than before. What type of companies qualify for the 1202 small business stock? 1202 paragraph on the Internal Revenue Services is a very extensive rules that apply to particular companies. I'm not aware of what they are. I just know that you have to qualify under certain provisions of that law. You can look it up. There is actually a couple of publications that are very easy to find online, and you can look up the qualifications. It's not easy to qualify. It's not every company can qualify, but there is certain requirements you have to meet in order to exclude gains from the proceeds of the sale from taxation. It does work, it does happen, but you have to be very careful, making sure that you are qualified out of those provisions. And I can look further for you in that. Remember, the IRS code is very extensive, right? So I would suggest if you're looking into, if you're a business owner, and if you're looking into 1202 rules, you need to talk to CPA. It's not going to be a straightforward answer. There is a lot of things you have to calculate and take into consideration. There is a holding period, there is a business purposes, there is all other things that make qualification work. All right. So I don't see any other questions. And let's see if we have. If I acquired RSU and ESPP, if I sell those after moving to a different state, country where tax is low, would I be avoiding taxes? So the federal law and the state law are very similar in that regard. And what it says that in general, you are paying taxes in a state where you earned your income. So let's break it down. RSUs and ESPPs are two different animals. RSU, restricted stock units, are reported on your W-2 by your employer based on where you earn that income. Because RSUs is part of compensation. You get taxed on it in a year you received RSU when they vest. So if your employer considering you earning your income in the state of California, even if you move to a different state, RSUs will be on your W-2, it tax in the state where you earned and lived, right? So most likely RSUs still will be subject, but ESPPs are a different story. Why? Because you can get your ESPPs and you can hold them long enough, more than a year from the time you bought it, and then you can sell them at the capital gain later on. Now, if you move, let's say state of Washington, and then you've been a resident there for 6 months or longer, and you decided to sell your ESPPs, now you're considered a resident of the state that doesn't have income state tax, which means that at the time you sell it, you don't have to pay tax on it, right? Because it's not, has nothing to do with your earning that. ESPPs is the purchase plan. So ESPP's gains potentially can avoid taxation. Now, remember that on the federal level, you still will need to pay capital gain tax, right? If your tax brackets are under certain levels. But on the state level, you might be able to avoid it, which is great advantage. You will be saving probably 10% of tax if you would live in California. Is the 4% still the minimum withdrawal rate for RMDs? Great question. So the answer is it's not exactly 4%. And also IRS just redid their life tables based on actuaries' responses, because life expectancy went up, the RMD age went up, right, to 72 now. So the table has changed, and I do have a table somewhere, but I will give you an idea that it's about 3.8%, and it goes up incrementally based on your age and your life expectancy. So the tables change, they do change every year, very small change, but it's about 3.8. But it's not a constant number. As we age, that number goes higher and higher and higher. In fact, by the time you are 87 or 88, it's almost like 7 or 8%. So it increases over the years, but a great question. Let's see. How can you find an RMD tables? So if you go, I'm just looking it up for you. I think if you type 2022 RMD table, you will find it under the newretirement.com plans. And there is a lot of information on that. I also have a table if you need it. My information, it was in the beginning of the slides. I'll share, you can ask me, I'll send you the entire table. You also have required minimum distribution worksheets available you can use online. And remember, your broker dealer also will calculate it for you on your behalf. So you can calculate yourself, and then the broker dealer will also tell you what's the number, and then you can compare both. Yes, I can send, I definitely can send the link, but I don't know how to send it. Should I send it through the chat? I wasn't sure.
I sent a link.
Thank you, Lisa. Thank you. Perfect. That's awesome. All right. So let's see what else we have here. Why don't we finish a couple more slides, and we'll take a couple more questions. Qualified charitable distributions from an IRA. This rule has not changed. So this is a great way for you if you're charitably inclined and you don't need your RMDs, since we're on RMD subject. You can direct part of your RMDs toward the charitable institution. It has to be qualified 501c3 nonprofit organization. It can be just any nonprofit. And then let's say your RMD total is 20,000 for the year, but if you made a 5,000 contribution toward the qualified charity directly, then you will be reporting only $15,000 as an RMD subject to tax. So anything that you can pass on directly to charity, and the check will go to charitable organization, that amount is excluded from your overall taxation. And it's available to at age 70 and a half, even though RMD age is 72. So you can do it anytime after that age. The most advantageous age to do charitable distributions from the IRA accounts, we call them qualified charitable distributions, that once you become subject to RMDs, to minimize the RMD impact on your taxes. One question more on the more like the tactical side. My IRAs are spread in 4 places. How best to do the RMD withdrawal? Well, a couple of thoughts. First is it's probably for the ease of management, unless there is a reason to keep them in 4 institutions. Maybe you can minimize it to 2. But if you would like to keep it in 4, you can either get the number from each institution, how much your RMDs, or calculate it yourself, and then take it out of 1 place. You don't have to take it out of 4 places. You can take it from 1 place, as long as you take all of those sums of 4 together before end of the year. If you don't, there is a 50% penalty on the amounts that haven't been taken out. All right, let's see if we have a tax planning strategies list. There is a number of things to consider. Most importantly, that you need to start doing the tax planning in January, right after you file your taxes for the previous year. So we usually start our tax planning for the following year in December. So December 21, 2021 would be a perfect year to start planning. And now till June would be some planning done for 2022. After second part of 2022, sometimes it's harder to plan because you need to implement certain strategies ahead of time. So planning for 2022, the answer is now, and RMD required minimum distributions are not due till December 31st. You can wait on those, and consider either to Ros Conversions also if you're in a lower tax bracket, and the deadline for that is also December 31st. So we will take a few more questions. Charity contributions is limited to 50% of adjusted income. Can RMD be contributed prior to calculating an adjusted gross income? RMD, right, RMDs are not related to AGI at all. RMD is calculated based on the balance of your total retirement pre-tax accounts, not Roth, the regular IRA accounts as of December 31st of the prior year. So example is, if you had $1 million combined IRA and 401k accounts value as of December 31st, then your RMD will be $38,000 or so if you're 72. So they're calculated based on the prior year balance as of December 31st, 2021, and then we'll apply the age factor to come up to RMDs. Correct, 38,000 is ordinary income, absolutely right. Utilize strategies to maximize equity compensation benefits. Great question, thanks for that. So it depends on what's available with your employer. So if you are in a very high tax bracket, let's say you're a C-level on a mid-sized company, and we advise the clients who are on that level of income, there is a lot of ways for you to slice and dice your income. You might have a deferred compensation plan available. You might have pension benefits available that's company making on your behalf. You might have RSUs that vest annually, and you can also push out part of your income in the following year. So there is a lot of ways for you to maneuver with your income based what company is making available to you. Companies sometimes offer you a deferred compensation plan, right? So you need to determine, if you're taking a deferred comp, how your income will be affected once you retire or you leave the company. Because a lot of times once you leave the company, the deferred compensation amounts is payable to you within a year or 5 years. So you need to decide, does it make sense, or you're planning to stay with the company longer? So one of the biggest planning tool is deferred compensation plan. Another one is 10B51 plan, where you can have an RSU sell plan determined with your company if you're one of the insiders for the company. Your 401k, your Roth 401k, your after-tax contributions is the huge planning tool for you to put away toward retirement, and also in tax-deferred or tax-free accounts like after-tax account and Roth accounts. So all of those strategies are applicable depending on your income level and depending also what kind of deferred compensation plan is available through your employer. Is it advantageous or not? You need to determine the terms of the plan. Can RMD can be directly donated to, let's see, I'm just trying to read this. So can RMD be donated directly to 503 and not to be included in? Absolutely. You can donate your entire RMD to a 501c3 company and have zero taxable income reported because of that. Yes, absolutely. someone has a 401k for a long time ago and it doesn't remember, and they had a rollover. The company since has shut down. How do I find out about where the money is? Oh, that's tough. I would suggest if you have any records to see what was the custodian for the 401k plan. Custodian would be companies like Fidelity, for instance. It's a startup company, right? And they have an ADP running their plan as a custodian. So the employer is a sponsoring company of the plan. Custodian is the broker dealer who holds the money in custody on your behalf. So maybe what you can do is you can try to remember, pull your statements, pull your employment letters to see who was the custodian at that time. And let's say custodian, you figure out custodian was Fidelity or Schwab or E-Trade or Ameritrade. Then you would need to reach out directly to the custodian, give them the name of your employer, and to see if they have any records what happened to your 401k. That's the only way I would go, because if the employer is shut down, you have no records of it, they must have either left the plan behind or shut down the plan. If they shut down the plan, then and the assets were not taken out, which I'm surprised. Usually you would get letters from custodians saying, please take the money out, we're closing the plan. So if you haven't received anything, potentially you might not have the money there. But double check with the custodian if you know who the custodian is. Can you explain, so we will take 2 more questions and I think we have to wrap up. Can you explain what are considered qualified distribution from IRA? Great question. So if you are not 59 and a half yet, because remember, if you are 59 and a half, after that you can take money from IRA without penalty, right? So qualified IRA distributions is certain events that happening, and you have to prove that you are eligible for no penalty withdrawals. Generally, those are, there's few exceptions to it, but generally it's disability, one of them, and I'm looking at a few others. So you have to be disabled. You can take it for educational expenses without penalty. So health insurance premiums while unemployed, unreimbursed medical expenses, permanent disability, so you can take during that time, high education expenses for yourself, and I believe also for your family members. And I think one more is to buy, build, or rebuild a home. You can withdraw up to $10,000 without penalty to buy, build, or rebuild a house. Usually for first home buyers, it works. The last one, I think, is you are if you are the beneficiary of IRA, withdrawals are subject to 10% early withdrawal penalty as well, but it's not on the regular IRA, it's only for inherited IRAs. You also can do something called substantially equal periodic payments. It's a rule where if you're not 59 and a half, you committing to start taking money from your IRA for before, but you have to continue making those payments to yourself over the course of at least long period of time, either whatever shorter is till you reach 59 and a half, or I think it's like 10 year, it's each year for 5 years until you reach 59 and a half. So if you want to take money without penalty, you need to give yourself certain amount of money, which is calculated through the formula, and this payments have to be annually taken out till you're 59 and a half, or 5 years, whichever is comes later. So there's few rules, but they are out there on IRS websites. All right, so I think this is all the questions we have right now. It's noon, so it's been great presenting, and I'm glad that we were able to cover lots of ground. Definitely there is a lot more to this act. As we all know, it's not certain what will happen. There are certain legislative changes that probably not going to be on the table right now, like a corporate rates increases, estate taxes increases, huge tax bracket increases not on table, but however, the higher net worth individual tax increase, SAL deduction probably will be available to us. So yet to be seen. Let's see what happens. Thank you very much. My pleasure. It was one of the most difficult presentations for me because there is so much uncertainty. So I'm trying to provide as much information as possible, as accurate as possible, but please keep in mind, things are right now very fluid and things can change. So when you do your planning, please do consult your tax professional or your financial advisor before final moves, all right? So all the best. Have a wonderful weekend, and we're hoping to reconnect sometimes in spring.